You don't feel a financial crisis when it starts. You feel it when the bill arrives. Maybe it's your property tax notice that's suddenly 18% higher than last year. Maybe it's your city announcing temporary service adjustments. Maybe it's a pension statement quietly lowering its expected return assumption. The real danger in public finance isn't a dramatic market crash on television. It's slow arithmetic failure. Right now, across the United States, commercial real estate vacancy rates in major downtowns are hovering near historic highs. In cities like Chicago and San Francisco, office vacancies have exceeded 20%. Nearly $1.50 to $2 trillion in commercial real estate loans are scheduled to mature between 2025 and 2027, according to industry estimates from mortgage banking groups. Many of those loans were issued when office buildings were worth far more than they are today. Refinancing them at higher interest rates against lower property values is becoming increasingly difficult. At the same time, public pension systems nationwide are, on average, around 70 to 75% funded, depending on the measurement standard. That means trillions of dollars in promised retirement benefits rely on future investment returns and continued tax revenue growth to stay stable. When markets perform well, the gap narrows. When markets stall, the gap widens quickly. Here's where psychology enters the equation. Most people assume states can't really fail. They believe Washington will step in. They believe taxes can always be raised. They believe something will prevent serious disruption. But public finance doesn't operate on belief, it operates on math. And math doesn't negotiate. When tax bases shrink because populations decline, when commercial property values fall and reduce local revenue, when pension costs rise faster than economic growth, something has to adjust. The adjustment rarely makes headlines first. It shows up in higher property taxes, reduced services, delayed infrastructure, higher borrowing costs, or long-term residents quietly moving away. The question isn't whether America is collapsing. It isn't. The question is which states are structurally more exposed as economic growth slows, refinancing becomes tighter, and investment returns underperform. Some states have strong buffers. Others are operating with thinner margins than most residents realize. In this breakdown, we're going to examine which states are carrying the heaviest long-term structural burdens, not based on fear, not based on politics, but based on debt ratios, pension funding levels, population trends, tax base concentration, and credit outlooks. And more importantly, what it realistically means for homeowners, retirees, business owners, and investors. Because by the time financial stress becomes obvious to everyone, the easiest options usually disappear first. Before we start naming states, we need to understand the mechanics. Because fiscal stress doesn't appear randomly, it follows a pattern. And once you see the pattern, you start noticing it everywhere. There are 5 pressure points that determine whether a state's finances are resilient or fragile. First, debt and pension obligations relative to economic size. Not just how much debt exists in raw dollars, but how large it is compared to the state's GDP and annual revenue. A $50 billion liability means very different things in a $4 trillion economy versus a $300 billion. Second, pension funding ratios and return assumptions. Most public pension systems assume long-term annual investment returns between 6.5% and 7.5%. If markets deliver that consistently, the systems remain manageable. If returns average significantly lower for a sustained period, contribution requirements from taxpayers rise sharply. According to data compiled by public retirement research groups, aggregate state pension funding levels improved after the post-pandemic market surge, but many systems still remain below fully funded status. A system sitting at 70% funded can stabilize with strong returns. A system below 50% funded has far less margin for error. Third, population trends. States growing in population expand their tax base naturally. More workers, more homeowners, more sales tax revenue. States losing residents face the opposite dynamic. Fixed obligations remain, but the number of taxpayers sharing the burden declines. Census migration data over the past several years shows clear winners and losers in interstate movement patterns. Fourth, tax concentration risk. Some states rely heavily on high-income earners or a narrow industry base. For example, states dependent on financial services, energy, or tourism can experience amplified volatility during downturns. When one sector contracts sharply, revenue can drop faster than expected. Fifth, borrowing costs and credit ratings. States with lower credit ratings pay higher interest rates when issuing bonds. Over time, even small differences in borrowing costs compound into billions in additional expense. When rating agencies shift outlooks from stable to negative, it signals increased fiscal vulnerability, even if a downgrade hasn't occurred yet. Now layer in the current national environment. Commercial real estate stress is real and measurable. Office occupancy remains structurally lower than pre-2020 levels in many major metro areas. Mortgage Bankers Association data shows a large wave of commercial mortgage maturities approaching over the next few years. Higher refinancing rates mean debt service costs will increase. That affects banks, property values, and local tax revenue tied to assessed valuation. At the same time, interest rates remain significantly higher than the ultra-low period between 2010 and 2021. That makes new borrowing more expensive for everyone: corporations, homeowners, and state governments. None of this guarantees collapse, but it tightens margins. And when margins tighten, weaker balance sheets feel it first. So instead of asking, which state will fail, a better question is, which states have the least flexibility if revenue slows and obligations stay fixed? We're going to examine 6 states that consistently appear in discussions about long-term fiscal stress, not because they're doomed, not because headlines say so, but because when you look at pension ratios, debt burdens, migration trends, tax structures, and economic concentration, they carry more structural pressure than most. We'll move from moderately vulnerable to structurally strained. And as we go, we'll separate perception from measurable reality. Let's begin with a state that rarely dominates national financial headlines, but whose pension mathematics have been studied by economists for years. If you want to understand how fiscal stress quietly builds, you start in a place like Kentucky, not because it's dramatic, not because markets are panicking, but because the numbers tell a story long before headlines ever do. Kentucky's economy produces roughly a few $100 billion in annual GDP, depending on the year. Its state budget revenue, however, is a fraction of that, generally in the range of tens of billions. That distinction matters. GDP measures economic output. The state budget reflects what lawmakers actually have available to spend, and pension obligations are paid from the budget, not from GDP. For years, Kentucky's public pension systems have ranked among the lowest funded in the country. Funding levels have improved slightly in recent years due to stronger market performance and increased contributions, but historically, major components of the system have hovered well below 60% funded. Some individual plans have been significantly lower at various points over the past decade. That means for every dollar promised in future retirement benefits, the system does not yet have a full dollar in assets set aside. Now, here's where psychology collides with math. Most retirees assume a pension promise is ironclad, and legally in many states pension protections are strong. Kentucky's constitution and statutes provide significant safeguards, but funding ratios don't measure legal promises. They measure assets versus liabilities, and when assets fall short, the gap must be closed by either higher investment returns, higher taxpayer contributions, benefit restructuring for future employees, or a combination of all three. Kentucky has already taken steps over the past several years to reform benefits for new hires and increase contributions. Lawmakers have made progress compared to where the state stood a decade ago. But even with reforms, required annual pension contributions consume a substantial share of the state's general fund budget. That means money directed toward retirement costs is money not available for infrastructure, education expansion, tax relief, or economic incentives. In a stable economy, that pressure is manageable. But, in a downturn, revenue volatility changes the equation. Kentucky relies heavily on income taxes and sales taxes. If unemployment rises, or consumer spending contracts, revenue declines. Meanwhile, pension contribution requirements don't automatically shrink during recessions. In fact, if investment returns underperform during a market downturn, required contributions can rise. That's the squeeze. It's not about default tomorrow. It's about limited flexibility. Kentucky also faces demographic headwinds common to many Midwestern and Appalachian states. Population growth has been slower than Sunbelt states like Texas or Florida. Slower growth means a slower expansion of the tax base. When obligations grow faster than the population contributing to them, long-term strain increases. Credit rating agencies have historically cited pension liabilities as a key risk factor for Kentucky's long-term outlook. While the state is not in junk territory and has taken steps to stabilize its finances, rating reports consistently highlight pension funding as an area of concern. And ratings matter. A lower rating means higher borrowing costs for roads, schools, and public projects. So, what does this mean for someone living there? If you're a homeowner, rising pension contributions can indirectly pressure property taxes at the local level, especially in municipalities managing their own retirement systems. If you're a state employee, reforms are more likely to affect future accruals rather than current retirees, but assumptions about guaranteed growth should be conservative. If you're a business owner, fiscal constraints can limit the state's ability to offer aggressive incentives compared to faster-growing states. But here's the most important point. Kentucky's situation is not explosive. It's structural, it's slow-moving pressure, the kind that compounds quietly if economic growth doesn't outpace obligations. And that's what makes it powerful, because structural problems don't disappear with one strong year in the stock market. Now we move to a state where the numbers are larger, the tax burden is already among the highest in the nation, and outmigration has become part of the financial conversation. If Kentucky represents structural pension strain in a slower growth state, New Jersey represents something different, a high-income, high-tax state operating with very little room left to maneuver. On paper, New Jersey is wealthy. It consistently ranks near the top in median household income. It sits next to New York City, benefits from financial services, pharmaceuticals, logistics, and dense suburban development. This is not a weak economy. And yet, when you look at long-term liabilities, the pressure becomes harder to ignore. New Jersey's public pension system has long ranked among the lowest funded in the country. Depending on the measurement method and the specific plan, aggregate funding levels have hovered around the low to mid 40% range in recent years. That means less than half of promised future pension benefits are currently backed by invested assets. The state has made increased contributions in recent budgets, including record payments, but the accumulated unfunded liability remains one of the largest in the United States in absolute terms. This is where the trap forms. Unlike lower tax states, New Jersey is already operating with some of the highest property taxes in the country. Average annual property tax bills frequently exceed $9,000 per household. In some counties, they're much higher. That means lawmakers don't have the same flexibility to simply raise taxes a little more, without political and economic consequences. And migration data tells a story here. Over the past several years, census estimates show net outmigration from New Jersey to lower tax states, particularly Florida and the Carolinas. When higher income residents relocate, the impact on income tax revenue can be disproportionate. A relatively small number of high earners often contribute a large share of total income tax collections. New Jersey also relies heavily on income taxes tied to financial markets and high-income professionals. During strong market years, revenue surges. During market downturns, collections can drop sharply. That volatility complicates long-term pension funding strategies because required contributions remain steady even when revenue swings. Credit rating agencies have repeatedly cited pension underfunding as a central credit risk. While New Jersey has avoided junk status, it is often ranked near the bottom among U.S. states in credit quality. Lower ratings translate into higher borrowing costs. Over decades, even a modest difference in interest rates compounds into billions in additional expense. Now layer in commercial real estate stress. Parts of northern New Jersey are closely tied to office demand linked to Manhattan and regional business hubs. With office vacancy rates elevated in major metropolitan areas and refinancing costs higher than a few years ago, assessed property values could face pressure if market weakness persists. Lower property values eventually filter into property tax revenue, though often with a lag. Again, this isn't a prediction of sudden collapse, it's a discussion of margin compression. New Jersey's challenge isn't lack of wealth, it's that so much of that wealth is already committed to pensions, debt service, and structural budget obligations. When obligations consume a large share of recurring revenue, flexibility shrinks. For residents, that means a few things. If you're a homeowner, long-term property tax stability is less certain than in lower liability states. If you're a public employee, the state has been increasing contributions to stabilize the pension system, but funding improvements depend heavily on sustained investment performance. If you're a business owner, tax predictability becomes a major planning variable. The deeper risk is a feedback loop. High taxes contribute to outmigration. Outmigration narrows the tax base. A narrower tax base makes existing obligations heavier per remaining resident. That dynamic doesn't explode overnight. It compounds. And when compounding works against you instead of for you, it's relentless. Now we shift to a state facing a completely different kind of vulnerability. One driven less by tax rates and more by geographic isolation and economic concentration. Hawaii looks financially different from the mainland states we've discussed. It doesn't dominate headlines for tax revolts or mass pension protests. It doesn't sit next to a financial capital like New York. It isn't losing hundreds of thousands of residents in a single census cycle, but its vulnerability is built into geography itself. Hawaii is the most physically isolated state in the country. Everything structural about its economy flows from that reality. Tourism is the backbone. Before the pandemic, tourism directly and indirectly accounted for roughly a quarter of Hawaii's economy, when you combine hotels, restaurants, transportation, retail, and related services. When visitor arrivals are strong, revenue flows through nearly every layer of the state budget. When visitor numbers fall, the contraction spreads quickly. During 2020, Visitor arrivals collapsed by roughly 70% at the height of travel restrictions. The economic shock was immediate. Tax revenue declined sharply. Unemployment spiked. The state relied heavily on federal assistance to stabilize conditions. Tourism has since recovered significantly, but that episode demonstrated something important. Hawaii's revenue base is highly sensitive to external economic conditions. Now add pension and long-term liabilities into the picture. Hawaii's public pension funding ratio has generally been stronger than some of the most stressed states, often hovering around the 60 to 70% range depending on the plan and market performance. That's not catastrophic, but it isn't fully funded either. Like most states, Hawaii assumes long-term investment returns in the 6 to 7% range. If markets underperform for several consecutive years, required contributions increase. Beyond pensions, Hawaii also carries significant retiree healthcare obligations, known as OPEB liabilities. When combined with pension obligations, total long-term liabilities become more substantial relative to the state's size. And size matters here. Hawaii's GDP is much smaller than large mainland economies. That means even moderate absolute liabilities represent a higher percentage of total economic output. When you divide obligations by the size of the revenue base, the ratio tightens quickly. Then there's the cost of living factor. Hawaii consistently ranks as one of the most expensive states in the country. Housing costs are often double the national average. Groceries and imported goods cost significantly more due to shipping expenses. When the cost of living is high, economic downturns hit households harder because there's less room to compress spending. Migration patterns reflect this tension. Hawaii has experienced periods of net out-migration, particularly among working-age residents seeking lower costs on the mainland. While population shifts haven't been as dramatic as in Illinois or New York, the long-term trend shows that high costs can gradually erode the resident tax base. Now consider what happens during a mainland recession. If unemployment rises in California, Texas, or the Midwest, discretionary travel spending declines. Vacations are often one of the first expenses households cut when budgets tighten. A 20 to 30% drop in tourism for a sustained period would significantly reduce Hawaii's tax collections. Unlike diversified states with multiple economic engines, manufacturing, finance, technology, energy, Hawaii's concentration risk magnifies volatility. Credit rating agencies generally view Hawaii as stable, but closely monitor its reliance on tourism and long-term liabilities. It is not near junk territory. It is not an immediate crisis, but its economic concentration means it has less diversification cushion if an external shock hits. For residents, the calculus becomes practical rather than dramatic. If you work in tourism or hospitality, your income is more sensitive to national economic cycles than many mainland industries. If you own investment property dependent on short-term rentals or vacation demand, revenue volatility is inherently higher. If you're planning retirement, conservative assumptions about future state fiscal flexibility are wise, not because collapse is imminent, but because economic concentration limits margin for error. Hawaii's risk isn't about reckless spending. It's about dependency on a single dominant revenue stream and the high cost structure layered on top of it. And dependency creates fragility when external conditions shift. Now we move to a state that has spent years being cited in fiscal policy discussions as the case study in long-term structural imbalance. A state with one of the lowest pension funding ratios in the nation and a history of population decline. If there's one state that economists, credit analysts, and policy researchers consistently reference when discussing long-term fiscal strain, it's Illinois. Not because it's about to implode tomorrow, not because markets are panicking, but because the arithmetic has been tight for decades, and compounding works both ways. Illinois has one of the largest state economies in the country, producing over $1 trillion in annual GDP. Chicago alone remains a major financial, transportation, and logistics hub. This is not a weak economic base. The issue has never been economic capacity. The issue has been long-term liabilities growing faster than political solutions. Illinois' pension funding ratio has historically ranked among the lowest in the United States. Depending on the specific system and measurement method, aggregate funded levels have hovered in the low 40% range in recent years. That means more than half of promised retirement benefits are not currently backed by invested assets. The unfunded liability runs into the hundreds of billions of dollars when measured using official actuarial assumptions. Now pause on that. When a pension system is 90% funded, it can absorb market volatility. When it's 70% funded, it requires discipline and stable returns. When it's near 40%, even small economic shocks require large budget adjustments. Illinois also has unusually strong constitutional protections for pension benefits. In 2015, The Illinois Supreme Court ruled that pension benefits for public workers cannot be reduced, reinforcing strict legal protections. That limits policymakers' options. They can increase contributions, they can adjust benefits for new employees, but they cannot easily reduce what has already been promised to current workers and retirees. So, the adjustment lever becomes revenue. Illinois already has relatively high property taxes, particularly in Cook County. Over the past decade, property tax burdens have increased significantly in certain regions as local governments attempt to manage pension and debt obligations. High property taxes, in turn, contribute to migration decisions for some residents and businesses. Population trends are critical here. Census data over recent years has shown Illinois experiencing net population declines, particularly among working-age residents. When population falls, the tax base shrinks. But pension obligations remain fixed in nominal terms. That means each remaining taxpayer carries a slightly larger share of the burden
Credit
over
ratings
time.
reflect this structural
It's the
strain.
slow squeeze. Illinois has often ranked at or near the lowest credit rating among U.S. states, though it remains above junk status. Lower credit ratings mean higher interest rates when issuing bonds. Higher interest costs mean a larger share of the state budget goes toward debt service rather than current services. And now layer in commercial real estate dynamics. Chicago's downtown office vacancy rates have remained elevated compared to pre-2020 levels. Remote and hybrid work trends have reduced demand for certain categories of office space. When assessed property values decline, local property tax collections can eventually feel pressure. While reassessments and tax structures complicate the timing, long-term weakness in commercial real estate is not fiscally neutral. Again, this is not about predicting default. U.S. states have strong revenue-raising authority, and Illinois continues to meet its obligations. The state has made increased pension contributions in recent budgets, and has benefited from periods of strong market performance. But structural imbalance means limited margin. If economic growth slows and market returns underperform simultaneously, required pension contributions could rise further as a share of the budget. If population continues to decline, per capita burdens increase. If borrowing costs remain elevated relative to other states, capital projects become more expensive. For residents, the implications are practical rather than apocalyptic. If you own property, long-term tax pressure is a variable you cannot ignore. If you're a public employee or retiree, legal protections are strong, but funding ratios mean long-term stability depends heavily on sustained economic growth and disciplined contributions. If you're a business owner, comparing tax predictability across state lines becomes part of strategic planning. Illinois is not collapsing, but it is operating with thinner fiscal cushions than most large states. And when cushions are thin, the system becomes more sensitive to external shocks. Now we move to a state that is often described as too big to fail, a state with enormous economic output, vast tax revenue, and global influence. The numbers look manageable at first glance, but when you look deeper into pension scale, revenue volatility, and economic concentration,
California is
the
often
story
described
becomes
with
more
a kind
complex.
of
Financial myth attached to it. It's the fourth largest economy in the world if measured as a standalone entity. Its GDP is approaching $4 trillion. It houses Silicon Valley, Hollywood, agriculture that feeds the nation, ports that move global trade. When people say too big to fail, this is usually the state they're thinking about. And on the surface, some of the debt ratios don't look alarming. Direct bonded debt as a percentage of GDP is relatively modest compared to several smaller states. Revenue totals are enormous. During strong years, California can generate record budget surpluses. But the vulnerability isn't about size. It's about volatility and long-term commitments. California's tax system is highly progressive and heavily reliant on high-income earners. In some years, the top 1% of taxpayers account for close to half of personal income tax revenue. That structure works beautifully when stock markets are rising, IPOs are booming, and capital gains are flowing. Revenue surges, budgets expand, reserves grow. But when markets correct, capital gains evaporate quickly. Income tax collections can fall sharply in a single fiscal year. California has experienced this boom-bust revenue cycle multiple times over the past 2 decades. Now layer in pension obligations. CalPERS and CalSTARS, the state's major public retirement systems, manage hundreds of billions of dollars in assets. Funding levels have improved compared to the years following the 2008 financial crisis, often reported in the 70% range depending on assumptions and valuation methods. That is significantly stronger than Illinois or New Jersey. But the scale of the system is massive. Even a 5–10% underperformance in investment returns translates into tens of billions of dollars in additional funding pressure over time. Like other states, California assumes long-term annual returns in the high 6% to low 7% range. If markets deliver that over decades, the system remains manageable. If returns average materially lower, required employer contributions, funded by taxpayers, increase. There's also deferred infrastructure. California has significant long-term obligations for transportation, water systems, wildfire mitigation, and public works. While not all of this is debt in the traditional sense, it represents future spending commitments that compete with pension contributions and social programs for budget space. Migration trends add another layer. In recent years, California experienced net outmigration, particularly to states like Texas, Arizona, and Florida. While the population decline has stabilized somewhat, the risk isn't simply the number of people leaving. It's the income profile of those departing. When higher-income households relocate, the impact on income tax revenue can be disproportionate. Housing affordability also plays a central role. California's median home prices remain among the highest in the country. High housing costs can limit labor mobility within the state and increase long-term pressure on wage growth. If housing markets cool while property tax growth slows, local governments may face tighter budgets. Commercial real estate stress is particularly visible in cities like San Francisco, where office vacancy rates have climbed well above pre-2020 levels. Lower commercial property valuations can eventually translate into reduced local tax revenue. That doesn't bankrupt a state of California's size, but it reduces flexibility. Credit rating agencies generally rate California solidly investment grade, but they consistently highlight revenue volatility as a core structural risk. That volatility means the state must manage
When
reserves
reserves are
carefully.
strong,
California can absorb downturns. When surpluses are spent during boom years without structural reform, the next downturn becomes more painful. Here's the key distinction. California's challenge is cyclical amplification, not immediate insolvency. When markets boom, California outperforms. When markets contract, California feels it faster than diversified, consumption-based tax states. For residents, that means planning with volatility in mind. If you work in technology or industries tied to equity compensation, your income may be more sensitive to market cycles than the national average. If you own high-value property in urban cores heavily dependent on commercial real estate health, valuations may fluctuate more sharply. If you're a public employee, the pension system is stronger than some states, but long-term sustainability still depends on investment performance and disciplined contributions. California is not structurally weak in the same way Illinois is. It has enormous economic capacity and significant institutional strength. But its size can create complacency. And complacency is dangerous in a system that depends heavily on capital gains and high-income tax concentration. Scale provides power. Volatility introduces risk. And when volatility meets long-term obligations, flexibility becomes the deciding factor. We've now examined several states with different kinds of exposure: pension-heavy states, tourism-dependent states, migration-challenged states, and volatility-prone giants. What ties them together isn't collapse, it's margin. In the final segment, we step back and answer the bigger question: what should individuals actually do with this information? How do you think about property, retirement, banking exposure, and mobility when states carry structural pressure? Here's the mistake most people make when they hear discussions like this. They immediately jump to extremes. Either they assume disaster is imminent, or they dismiss everything entirely because their state hasn't collapsed yet. Both reactions miss the point. This isn't about panic, it's about positioning. States rarely fail overnight. What actually happens is slower and far more personal. Taxes adjust. Fees rise. Services narrow. Infrastructure projects get delayed. Pension contributions crowd out other spending. Borrowing becomes more expensive. Businesses reconsider expansion. Higher-income households quietly relocate. The adjustment happens in increments, and increments compound. Let's zoom out to the national level for a moment. The United States as a whole has a highly developed municipal bond market, strong legal frameworks, and broad taxing authority at the state level. Historically, outright state-level defaults are extremely rare. That's important context. The system has resilience. But resilience doesn't eliminate pressure. Commercial real estate stress is real and measurable. Pension obligations are long-term and mathematically binding. Demographic shifts are documented in census data. Revenue volatility in high-income tax states is observable across multiple business cycles. These aren't predictions. They're patterns already visible in public records. So what should an individual actually think about? First, understand exposure concentration. If your job, your home equity, your retirement benefits, and your banking relationships are all tied to one state facing structural fiscal pressure, Your financial life is concentrated. Concentration amplifies risk. Diversification reduces it. That doesn't mean abandoning your state. It means being aware of how much of your net worth depends on a single local system. Second, distinguish between short-term headlines and long-term balance sheets. A single, strong stock market year can temporarily improve pension funding ratios. A single economic slowdown can reduce tax revenue. But structural challenges are multi-decade stories. When evaluating where you live or invest, look at funding trends over 10-15 years, not one budget cycle. Third, pay attention to credit signals. Credit rating agencies don't operate on emotion. When outlooks shift from stable to negative, or when borrowing costs diverge significantly from peer states, that's a measurable signal. It doesn't mean collapse, it means reduced flexibility. And reduced flexibility often precedes policy adjustments, usually in the form of tax changes or spending reprioritization. Fourth, consider mobility as an economic advantage. In previous generations, geographic mobility was often limited by industry concentration. Today, remote work, digital businesses, and portable skill sets create options. States with strong in-migration tend to benefit from expanding tax bases. States with persistent out-migration face tighter fiscal arithmetic. Being able to relocate if necessary is not a political statement. It's a financial option. Fifth, be realistic about pensions. Public pensions in the United States are legally protected in many states and historically have been honored. But funding ratios matter. Even when benefits are not cut outright, cost of living adjustments can be modified. Contribution rates can increase for current workers, and new tiers for future employees can reduce long-term generosity. Planning conservatively, assuming modest adjustments over time, is simply prudent risk management. Sixth, separate narrative from numbers. There is a difference between "this state is collapsing" and "this state has thinner fiscal cushions than peers." The latter is measurable, the former is sensational. Mature financial decision-making operates in the middle ground. Now, step back and look at the broader picture. America is not entering a uniform fiscal crisis. It's entering an era of divergence. Some states are growing rapidly, expanding tax bases, and improving fiscal ratios. Others are managing heavy legacy obligations accumulated over decades. Economic cycles will amplify these differences. During expansion periods, the gaps narrow. During downturns, they widen. That divergence creates opportunity for some and strain for others. And here's the psychological reality. Most people don't act during the early boring phase of structural change. They act during the obvious phase, when tax bills spike, when layoffs begin, when headlines turn urgent. By that point, housing markets may already have adjusted. Policy changes may already be locked in. Credit conditions may already be tighter. The window for optionality is always largest before urgency becomes public. But that doesn't mean rushing into dramatic decisions. It means asking calm, rational questions. How stable is my state's long-term balance sheet relative to others? How diversified is my personal financial exposure? How sensitive is my income to economic cycles specific to my state? How mobile am I if conditions change? These are strategic questions, not emotional ones. Because fiscal stress at the state level doesn't start in Washington. It doesn't start on cable news. It starts quietly in actuarial tables, in commercial refinancing schedules, in migration reports, in bond yield spreads. Math moves first, policy reacts second. Public awareness comes last. The goal isn't fear, it's awareness. When you understand which states are carrying heavier structural burdens, pension funding gaps, concentrated tax bases, volatile revenue streams, population decline, you're no longer reacting to headlines. You're interpreting trends, and in finance, interpretation always beats reaction. The next economic slowdown will not treat every state equally. Some will absorb it with reserves and flexibility. Others will face harder trade-offs. That's not speculation. That's how federalism works. The question isn't whether America survives. It will. The real question is whether your financial life is positioned in a state with expanding margins or tightening ones. And that decision, unlike pension math or bond markets, is still entirely within your control.